If you're retired or preparing for retirement, these four silent mistakes can drain six figures, delay your retirement, and force cutbacks, which means fewer trips, tighter budgets, and maybe even part time work. If you don't see these and fix them now, you'll spend your later years cutting back and wondering where all your hard work went. Hi, I'm Jason. I build retirement plans every week. And today, I'm going to share with you these four mistakes and a plan to turn these pitfalls into opportunities. I think all of us want to avoid mistakes and figure out a better way to do things. And it reminds me of a funny story that my brother often tells about his daughter, Eleanor. And it was one Saturday morning, and my brother was sanding down an old piece of furniture. And Eleanor walked in and asked, "Hey, what are you doing, Daddy?" And he said, "Well, I'm getting the paint off of this old piece of furniture." And she said, "Okay." And she left. Well, the next day, after they got back from church, they had a big day of washing the cars. And of course, the kids beat him out there. And as he walked out and was looking through the garage, he could see his daughter Eleanor with that sandpaper rubbing the front of his car. So, of course, he ran up and said, "Eleanor, what are you doing?" And she said, "I'm getting the bugs off of the car, Daddy." And he realized that she thought this was the best way to get the bugs off of the car. But he let her know there are better ways to do that. All right. And so it was a mistake on Eleanor's part because she just didn't know there was a better way. So today I want to share with you four mistakes so you can avoid them because there's a better way to go about this. So, mistake number one that is draining your retirement fund is pulling from the wrong tax bucket. So first I want to explain what are the tax buckets. Well, there's three tax buckets: the taxable bucket, the tax deferred bucket, and the tax-free bucket. The taxable bucket, you can think of this as an individual account that you have, maybe a joint account that you have with your husband or your wife, or possibly a trust account, all right? It's taxed at capital gains tax rates. And then we have the tax deferred bucket. These are typically IRAs, 401ks. They're retirement savings that we haven't paid taxes on, and they're taxed at ordinary income tax rates. And then we have the highly coveted tax-free bucket. And the most common example of this is a Roth account. So the first mistake is pulling from the wrong tax bucket. And we're really talking about the order in which we pull from our tax buckets. Now, everybody's situation is different, but in general, you want to pull from taxable money first. Then we want to pull from tax deferred money or tax deferred accounts. And lastly, we want to pull from tax-free accounts. And why do we want to do this? Well, if we pull from taxable money first, we're only taxed at capital gains tax rates. We're only taxed on the gains. Then we want to pull from tax deferred buckets. And again, that's taxed at ordinary income tax rates. And that's because we want to let our tax-free bucket grow. We want to go here last. And why do we want to do this? Well, we want that money to grow, number one, so that we have an inflation hedge because things are going to cost more tomorrow than they do today. And we will not have to pay any taxes whenever we pull this money out. So we want this money to grow and grow and grow as long as possible so that bucket gets the largest. And then whenever we pull from it, we don't have to pay the IRS. And this first mistake actually has two parts, all right? So first is pulling from the wrong tax bucket in terms of the order in which we pull from them. The other mistake that we oftentimes see that can really drain your retirement funds is putting the wrong investments into these different tax buckets. So, what's a good example of an asset that you want to put in the taxable bucket? Well, a good example is index funds or ETFs. And typically, the good thing about most index funds or ETFs is they have low turnover. So there's not a ton of buying or selling because they're passive investments. And then also, they typically have low dividends because dividends, when they're in the taxable bucket, end up hitting our 1040. They end up hitting our ordinary income tax rate. So we want to put index funds or ETFs in the taxable bucket. And then we want to move over to the tax deferred bucket. So what types of assets do we want to put in the tax deferred bucket? Well, Some examples of that are bonds or CDs, because bonds pay interest and so do CDs. Those pay interest as well. Well, that income that we would receive, that interest income that we would receive from bonds or from CDs, it stays tax deferred. It doesn't hit our 1040, it doesn't hit our taxable income. So, lastly, what are the types of assets that we want to put in the tax free bucket? These are the assets that we expect to grow the most. So, typically, they're growth stocks. And we want to put growth stocks in the tax free bucket because we really, really want them to appreciate. And we want this bucket to grow to as big as possible, right? So we don't have to pay the IRS whenever we take out distributions. And next, we want to cover mistake number two that's quietly draining your retirement fund. And that is when we miss the gap years window. So, what do I mean when I refer to the missing gap years window? Well, I'm referring to a period of time when it makes sense to move from the tax deferred bucket to the tax free bucket. Remember, tax deferred accounts are things like IRA, 401k, deferred comp, 457, any retirement account that you haven't paid taxes on. And what we want to do is we want to find an opportune time to move from the tax deferred bucket to the tax free bucket. Now, we're going to have to pay taxes, but we want to be able to find those periods of time when we can pay the least amount of taxes as possible. And so there is a window, these gap years, when it starts after we retire and it goes until we start taking Social Security. And then there's also a gap from the time we retire until we hit RMD age. Okay, so why is this the gap years window? Well, after we retire, our income goes down. And during that period of time, when we retire until we start taking Social Security, a lot of times we can control our income and our income is lower, meaning our income tax brackets are lower. So that's an opportunity to move from the tax deferred bucket to the tax free bucket. And we want to do this again before we get to RMD age. Because what is RMD? It's required minimum distribution. Because we don't want to have a really big tax deferred account when we hit RMD age. And for most people, after the Secure Act 2.0, that's age 73. So we don't want a really big tax deferred account when we hit RMD age because that is when the federal government says, now you have to take a distribution from this tax deferred account so that they can get their tax revenue. So we don't want to miss these gap years. We don't want to miss this opportunity to go from the tax deferred bucket to the tax free bucket. And it's typically when we retire before we hit Social Security or when we retire, especially before we hit RMD age. Because what we really want to avoid is a tax bomb. And what do I mean by a tax bomb? Well, that's when we kind of miss those gap years and we end up hitting RMD age. And then we have a really big required minimum distribution and we're forced to pay taxes when we could have done it at lower income tax rates if we would have done it during those gap years. So if you're watching this video, it's because you want to plan. You don't want to make mistakes. You want to do what is best for you and your family. And one of the questions that we oftentimes hear from our clients is, will my loved ones be okay whenever I walk out on life? And if you do have assets, if you own something and you love someone, you need to have a legacy plan. And that's why I want to invite you to click the link below and download our Quick Start Estate Planning Guide. This is free, it's a complimentary guide, and it has 3 easy steps. Step number one is to organize all of your accounts in one place. Step number two is to define a list of companies that you're going to need to call to start to get the things in order. And number three, it's going to give you the exact script, exactly the questions to ask and what to say, and even what to request to make sure you can start to get your estate in order. So, if you're worried about these things, if you're worried about what you have going to the people that you love, please click the link below and we'd love to send you that free Quick Start Estate Planning Guide. And speaking about walking out on life, that brings us to mistake number three, which is the widow's penalty. And what do I mean by the widow's penalty? Well, let's use an example. Larry and Melissa. Let's just say Larry has a really big tax deferred account. Okay. He has a really big IRA from his employer. And Larry really wants to preserve that for Melissa. He believes that he'll predecease Melissa and he wants to make sure that he keeps that intact. So whenever he gets to RMD age, he only takes out the required minimum distribution. He only takes out the minimum amount that the federal government requires him to do. And then Larry passes away and he passes on that IRA to Melissa. Now, Melissa can take that as her own IRA. That kind of becomes her own tax deferred account. Then, a couple of years later, Melissa hits age 73 and she needs to take RMDs. So she begins to take RMDs, but wait, she's going to have to file single now because she's a widow. And single filers have a lower standard deduction and they also have higher income tax brackets. So even though Larry had a really good desire, he wanted to preserve that money for Melissa, she's going to end up paying higher taxes than they would have if they would have done some planning while Larry was still alive. So falling victim to mistake number three, the widow's penalty, ends up paying higher taxes on the same dollars. And then mistake number four is sequence risk. So, what is sequence risk? Well, sequence risk in its most simple form is having to pull out money when assets are down. So, if stocks are down and you have to pull out money, you're locking in losses. And Boston College has something called the Center for Retirement Research. And sequence risk is one of the biggest risks to retirees. And if you're kind of adhering to that old rule, the 4% rule, it doesn't really take into account timing. It doesn't really take into account when you're pulling money out. So, to avoid sequence risk, we want to have our assets built like a financial house. Every retiree should have three different parts of their overall portfolio: a roof, walls, and foundation. So, what do I mean by roof? Roof, I'm referring to growth assets. Typically, we mean stocks. Wall investments are more moderate investments. A good example are bonds. And then lastly, we have foundation investments. Foundation investments are investments where we've transferred the risk to someone else. So with a CD or a money market, we transfer the risk to the bank. Or with an insurance product like life insurance or annuity, we've transferred the risk to the insurance carrier. So how does a financial house help us avoid sequence risk? Well, whenever we need income, we can pull from foundation. And I would argue you would want to have several years, sometimes 5 years, 10 years, maybe even 15 years of foundation investments so that you know you can pull from your foundation and you won't be locking in losses. And this is twofold. Number one, it helps you to avoid sequence risk. Number two, it allows your roof and your walls to grow because we're not pulling from the roof and the walls. And why is that important? Well, we need our roof and our walls to grow because we need to keep up with inflation. This is our inflation hedge. Things will cost more tomorrow than they do today. So we want that part of our portfolio that has the most opportunity to grow. We want that to keep growing. We want to allow that to keep growing because that is going to help our plan long term. And again, what is the effect of the sequence risk? Well, we deplete our savings faster. Well, I hope that this video was helpful to help you realize that you can avoid these four mistakes if you plan properly. You can turn pitfalls and opportunities. And remember, retirement just isn't about planning all of your tax buckets and all of your investments. It's about enjoying these golden years. And that's why I want to invite you to click this video here where I go over 11 activities for a fun and fulfilling retirement.